The Labor Department is set to release May employment figures, and Wall Street is wondering what that is going to tell us about the likelihood of a recession. Every month when the Labor Department releases jobs figures, it's a closely watched day on Wall Street, and sometimes a volatile one. But this time is actually going to be a little bit different. And why is that? Because markets are on recession watch. For what reason? Let's just take a look at what former US Treasury Secretary Larry Summers had to say recently. If you look at history, there has never been a moment when inflation was above 4% and unemployment was below 5% when we did not have a recession within the next 2 years. So where do we stand right now? Well, the April jobs report told us that the unemployment rate was around 3.6%. And the most recent read on inflation for April had us at 8.3%. Now, to be fair, this is a slight pullback from March when inflation was at a 4-decade high of 8.5%, but it is still well above the Federal Reserve's target of 2%. And we are all feeling the effects of this higher inflation. You notice it when you go grocery shopping, and you are certainly feeling it when you're filling up your gas tanks. And it's no wonder that higher inflation has caught the attention of the White House. Remember, President Joe Biden met with Jerome Powell days ahead of the Labor Department's report. So here's what economists are saying they expect to happen for May. They expect that the unemployment level is going to stay around 3.5 to 3.6%, which will have it hovering around 50-year lows. But there's other figures that Wall Street also watches. One is the pace of wage growth. We all love it when our paychecks go up, but when paychecks go up too quickly, that has an inflationary effect. The other thing that Wall Street will be watching is the pace of hiring. In April, we saw 428,000 jobs added to the economy. And this is roughly on par with the figure that we saw in March, but well below the 714,000 jobs that we saw added to the economy in February. It's great to see people going back to work, but when that hiring pace is too high, that could be a sign that the economy is getting overheated. So the reason why this May report is so significant is because it is coming roughly 2 weeks before the Federal Reserve has its policy setting meeting on June 14th and 15th. And they'll be using this data to determine their path on monetary policy. And this jobs report may be one where Wall Street is actually hoping for the news to not be so great. No one wants to see people losing jobs, but the pace of hiring, if it slows down, could be a sign that the economy is cooling down on its own. In fact, it was something Joe Biden even said in a recent Wall Street Journal op-ed. If average monthly job creation shifts in the next year from current levels of 500,000 to something closer to 150,000, it will be a sign that we are successfully moving into the next phase of recovery, as this kind of job growth is consistent with a low unemployment rate in a healthy economy. So what does all of this have to do with the Fed? When you think about what the Fed's job is, it has a dual mandate, keeping prices under control and also keeping unemployment low. And the Fed has 3 main ways that it is able to do this, which is to say, keep the economy running smoothly, and it's mostly through the control of the money supply. One way is the Fed sets the reserve ratio for banks. This is the percentage of reserves that banks have to hold on their deposits. The other way is through what's called open market operations, and this is when the Fed is either buying or selling government securities. When the Fed is a buyer of government securities, as it has been recently, that is actually expanding the money supply. But the third thing that the Fed can do, and this is the one that gets the most attention, is through the control of interest rates. So keep in mind, a little more than 2 years ago at the start of the pandemic, the Fed very quickly lowered interest rates to near zero. The reason it did this was to allow for banks to continue lending to customers and keeping the money supply just really flowing. Now, this had some other spillover effects. On Wall Street, we call it easy money. Now, when interest rates are low, we see a lot of other knock-on effects. During the pandemic, even when most of the economy was shut down, we saw the market heading to new highs pretty frequently. And The other thing that we see is people's appetite for so-called speculative assets actually increases because you're not earning as much interest on other assets, so you're going to look to speculative assets in the market where you can get a higher return. So this is why we saw tech companies that weren't yet profitable having their valuations soar. This is why we saw the market also really soar, even though much of the economy was shut down. But as we all know, anything that goes up quickly is going to eventually have to come down. And it is the Fed's job now to try to make sure that that come down isn't too hard or too quick. So last month, the Fed raised interest rates by 50 basis points. This is the first time that it has raised interest rates so quickly in over 20 years. But what really concerned the market was the fact that the Fed said it sees future 50 basis point hikes in its future. And that has people wondering, oh my gosh, is the Fed going to be raising rates too aggressively, and is the economy going to come to a screeching halt? Because in practical terms, when interest rates go up, that means borrowing costs for households and businesses also goes up. So in the case of businesses, their capacity to hire more workers, to grow, it becomes constrained if they're paying higher interest on their debt. So what we have right now is this very tricky situation where the Fed is trying to engineer a so-called soft landing, but a lot of Wall Street is worried that it's going to be a crash landing. Or to put it as Guggenheim Partners Chief Investment Officer Scott Minerd said at the Milken Conference in May, the central bank is the source of and solution to every financial crisis we've ever had. So when we get the May figures from the Labor Department, Wall Street is going to be looking for signs that the economy is still healthy, but not quite white hot. We'll be watching. But you tell us, is the US economy on the way to a recession? And if you think so, what are you doing to get recession ready?